It's a strange time on Wall Street. The usual rules seem to have been tossed aside, and the mood is unlike anything we've seen in years. Despite a government shutdown and missing economic data, the stock market keeps climbing to record highs. Every day, it seems, investors shrug off headlines that would once have sent shockwaves through the trading floor. The September jobs report is delayed, but instead of panicking, investors see the lack of news as a positive. No bad headlines to disrupt the rally. In fact, the absence of data has become a kind of comfort, allowing the market to move forward without obstacles. This market momentum seems unstoppable, fueled by a belief that nothing, not even political dysfunction, can derail the rise. The optimism is palpable, and the sense of invincibility grows with every new high. Investors are ignoring Washington's chaos, focusing instead on optimism and upward trends. They're betting that the market can outpace any trouble brewing in the capital, and so far, that bet is paying off. The disconnect between political turmoil and market confidence is striking. It's as if Wall Street and Washington are living in two separate realities, barely acknowledging each other's existence. Traders are marching to their own beat, undeterred by missing data or government gridlock. They're focused on the numbers that matter to them, and for now, those numbers are all pointing up. The question now, what's really driving this relentless rally, and how long can it last without real economic signals? Is it hope, momentum, or something else entirely that's keeping the market afloat? For now, the market's psychology is clear. Optimism outweighs uncertainty. The crowd is celebrating, convinced that good times will continue, even as warning signs flash in the background. But can this last if reality finally catches up? Sooner or later, the market will have to reckon with the facts. Until then, Wall Street seems content to dance to its own tune, ignoring the noise and chasing the next high. The answer lies with big tech and the AI boom. Tech giants are powering the market, seen as safe bets no matter the economic climate. The promise of AI has investors pouring money into anything with a hint of innovation, convinced it will reshape industries and deliver huge profits. This optimism is so strong it's blurring the line between smart investing and speculation. Even Jeff Bezos warns that while AI is real, the frenzy can lead to excess. Still, the market's faith in tech and AI is overriding short-term worries. Investors are betting on a future transformed by technology, not this week's headlines. That long-term vision is keeping the rally alive. The government shutdown has abruptly cut off the flow of vital economic data that investors, analysts, and policymakers rely on to make informed decisions. With no official numbers to guide them, investors and the Federal Reserve are essentially flying blind, navigating the markets without their usual instruments. The absence of the monthly jobs report means there's no clear read on the health of the labor market, leaving everyone guessing about the true state of employment and wages. As a result, investors and businesses are forced to rely on guesswork, patchy private surveys, and anecdotal evidence, which can be incomplete or misleading. The Federal Reserve, which depends on accurate data to set interest rates and guide the economy, now faces tough decisions with only a partial and potentially distorted picture. This uncertainty raises the risk of policy mistakes like keeping rates too high and slowing growth, or too low and fueling inflation, at exactly the wrong moment. Some investors see the blackout as a short-term plus, since no bad news can spoil the current rally. But this optimism is built on shaky ground. Markets need transparency and reliable information to function well and to price risk accurately. Relying on hope, momentum, and rumors instead of hard facts is like driving blindfolded down a busy highway, thrilling for a moment, but ultimately reckless and dangerous. For now, the market seems willing to shrug off the risk, focusing on optimism and the hope that things will work out. But the longer this data drought drags on, the greater the chance of a painful correction. Sooner or later, reality always returns, and when it does, the adjustment can be swift and severe. With official government data delayed, investors are left searching for clues about the economy's health. They turn to private reports like ADP's employment numbers and the ISM surveys, hoping to piece together the bigger picture. These alternative indicators are now showing that the labor market is cooling off much faster than most experts had predicted. Fewer new jobs, slower hiring, and more cautious employers are all signs of a slowdown. Oddly enough, this bad news is actually being welcomed by Wall Street. Investors are betting that signs of weakness will convince the Federal Reserve to stop raising interest rates, and maybe even start cutting them sooner than expected. Lower rates would mean cheaper borrowing for everyone, from families buying homes to businesses investing in growth. That's why the market is now in a bad news is good news phase, with investors hoping the Fed will step in if the economy stumbles. As a result, stock prices keep climbing. Not because the economy is booming, but because investors are confident that the Fed will provide support if things get worse. This optimism is powerful, and it's driving markets higher even as economic signals flash warning signs. But all of this hope rests on one thing: the belief that the Federal Reserve will act quickly and decisively to rescue the economy if needed. If the Fed hesitates or misjudges the moment, this wave of optimism could quickly turn to anxiety. For now, though, investors are watching every signal, waiting for the Fed's next move. It's tempting to chase the rally, but markets don't rise forever. Experts warn against abandoning long-term plans or trying to time the top. Reacting to headlines or FOMO usually leads to buying high and selling low. The best move? Stay disciplined, diversify, and focus on what you can control. Build a portfolio that matches your goals and risk tolerance. Diversification protects you from sudden shocks. Enjoy the optimism, but remember, financial gravity always returns. Stick to your plan, and you'll weather whatever comes next.